Well, the guy from The Big Short is back, Michael Burry, posting on X. So we're going to dive into some of the charts that he posted. And he came at a very interesting time, I should add, right when the Hindenburg Omen, the ominous signal, has returned. We're going to talk about that on today's Stock Market Brief show. We're also going to get into some of the intermarket things taking place and the market conditions and expected moves, what the market's pricing in for risk for this week, for tomorrow's trading session, and for the month of November. So stay tuned because it is a very cool chart that I want to go over. Let's get into today's show. Welcome back to the show, everybody. So Michael Burry from The Big Short is back posting. I want to go over some of those charts. He posts here. Sometimes we see bubbles. Sometimes there is something to do about it. Sometimes the only winning move is not to play. So basically, in short, what does a normal person pick up from this? Well, he's telling us that there's a bubble out here, but not to play it because, well, it could be bad. But what he's saying is a little bit different than what was just reported for the top increase in their quarter in his fund. You can see Palantir's 66% of the portfolio is in puts, and then 13% is in NVIDIA puts. And he also posted some interesting charts that I want to just point out here. And it's very cool kind of map of how everything's connected and just showing how NVIDIA and OpenAI are fueling this whole AI machine that's just absolutely incredibly large at this point. He also posted this chart here showing the green line is the tech sector capital expenditures growth, and then the beige line is the capital expenditure growth for technology, media, I believe it is, and telecom. I forget the M. I believe the M stands for media there. But what it's pointing out here is it's just showing that the recent rise into 2025 and 2025 is matching that of the tech bubble of 1990s and 2000s. The other chart that was posted was looking at the average of 2018 to 2022, that black bar of the cloud segment year-over-year growth. That was the average growth rates across those two periods. And then you could see the 23 to 25 this year, there's a pretty steep decline from those prior trading years. And then he's posted the last chart, or the last, was it just a highlighted portion of a book that's in, he said, move along. And in short, what I picked up from this was when there's too much capital, that floods into a hot sector like telecom in the 2000s, or maybe AI chips today, it eventually leads to overcapacity. You can potentially see falling margins, painful consolidations, and obviously pullbacks in the overall market. Now, I want to preface this with he's not perfect. And he says when he's wrong, but remember this tweet where it said sell in January 31st of 2023. And I mean, I guess it went a lot higher than that, then came down to exactly where he posted it and then ripped higher again. So, if you sold everything then, you miss on a pretty big run up for the remainder of the year. So yeah, take it with a grain of salt, but still it does come at some interesting times. Now, this is also coming at a time where if you look at, the survey of asset managers, you can see we're getting about 100 reading, which means that they're fully long, right? It's actually a little bit of leveraged long at this point because it's above 100. And sometimes these can act as contrarian type indicators where, like for example, if you go to 2017, you saw this thing over 120 and the market did go higher, but then bam, we saw a big kind of deflation of that move. And then we just went into massive volatility for the years to follow. And then if you go to something at the bottom of 2022, this was the most, bearish that we've seen it. We got very low readings of the asset managers. And if you look down here at the right X, it was also a very low reading as well. Now, another interesting note here is the Fed is about to start boosting financial markets again, apparently, right? And in that article, you can see that it states that the central bank will soon end its efforts to shrink its now roughly 6.6 trillion balance sheet and the program known as quantitative tightening, which began in 2022. So quantitative tightening is apparently coming to an end, which, you pull up this chart, you go back to articles back in June, the Fed was to begin quantitative tightening. What does that mean for the financial markets? And you can see quantitative did stop. And then over here, you see this little bump that happened to be in March. That was during the Silicon Valley banking debacle that went haywire. But now we've came in and now we're talking about stopping this program, which if you look into kind of what some of the economists say, like Bill Adams, it mentioned that this can translate into more liquidity financial markets and more private investment funds going into risky assets over a period of time. So It's interesting because this could be potentially bullish for markets, I guess, right? We've seen this happen before to be bullish for markets. The Fed is cutting rates. However, this next rate cut, the probabilities of no rate cut kind of increased. So maybe perhaps if we don't get a rate cut in December, which, we get our CPI data, and that could potentially, it could probably change just in a moment's notice if we get that CPI data, the government's still shut down, and maybe the rate hikes back on the table. But if we don't get the rate cut, perhaps maybe this end of quantitative tightening can kind of take its place. Perhaps we get both, right? Perhaps we get the rate cut and that takes place. And this always brings me back to this chart, this big picture chart, where we're looking at like the 10-year 3-month yield curve or the 10-year 2-year, whatever you want to look at. This is the 10-year 3-month, and then the federal funds rate over here. And you can see when they start the rate cutting cycle after an inversion, it starts to reinvert and steepen. And this was at all-time highs in the market, right? It was different this time. It was different this time. It was different this time. And every single time here, and this is now the longest and deepest inversion of the yield curve, or one of the longest, if not the largest, is at a new all-time high in the market. Market's been pressing higher. And yeah, so what's to say if this starts steepening up in the very near future, we can't see some more volatility in these markets. And we're coming into 2026. We're coming into the end of the year soon. If you want to look at something interesting that I've shared on a prior episode, looking at this cycle chart that was developed by a farmer in the 1800s, I thought it was just interesting because you can see we're kind of coming into the 2026 period. And the last time, right, you had 2016, which also lined up with 2019 right over here. That happened to be COVID. And then over here was the 2007. And then, shortly thereafter, we went into the great financial crisis. Over here was 1999, right? In 1999, we had the dot-com bubble. So everything's kind of aligning. It's just interesting stuff. And then we got our Hindenburg Omen signal. And, can you actually put a trade on base off of this? I don't know. I don't think so. I think it's just more of like one of those things that's saying, hey, there's things that are lining up. So if you understand when market conditions change, which I do, and I'm going to talk about, then I think you really want to pay very close attention to what's going on in the markets, because things can happen at a much faster pace, right? Risk happens slowly, right? Slowly builds up, which we're seeing, and then it can happen fast, right? But you don't want to just short the market or sell everything when you're in a very bullish market. We're a stone's throw away from an all-time high. Again, there's a lot of charts that are setting up too. So you're just at a very precarious place. And, if you're bearish for another 10% up in the market, and then the market drops, right, you're missing out on those opportunities. Whereas, or maybe you've been bearish since Michael, Burry said 2023, right? Yeah, maybe he's going to be right, or you're going to be right. But you don't want to miss out on huge gains during that time, right? The best time to make money is typically in bubbles, and when you're not fighting the trend, when you're trading with the trend. So I'm not going to get too much into the Hindenburg Omen signal. If you want to look at it, this is from Tom McClellan. He posted this, and I'm just pulled it off of Twitter here, and he's just showing that we got two signals. These are the requirements for it over here, and we did get those two signals back to back, and you can see like, hey, it was actually right before this drop off. That was pretty interesting. Over here, right, it didn't matter. Over here into 2022, it looked like it mattered. There's 4 signals. So in short, this looks to me like when you get more signals build on top of each other, perhaps that might mean a little bit more. He posted this chart too, going back to the 80s to 2014. And you can see over here too, in 2008 financial crisis, we had some stack up. Dot-com bubble, right? We started seeing them start to stack up, but like it kept going higher for a while. And then you started to see one or maybe multiple, I can't really tell, over here going into 1987, which was also great to know, right? It was great to know. If we take a look at breadth in the S&P 500 as we're pressing all-time highs, basically, the percent of stocks above the 20-day moving average, falling. Percent of stocks above the 50-day moving average, falling. Percent of stocks above the 200-day moving average, falling. So in theory, when you look at this and you see the market pressing all-time highs, it's just telling me that fewer names are driving the S&P 500. And you can look at the heat map today and get a good sense of that, right? You look at the heat map, you're seeing Amazon, it's up 4%, Tesla up 3%, Nvidia up 2%, and then you get a crud ton of red on the screen, okay? So few names, large names, important names to the S&P 500, and happens to be technology names, which is even more important because that's really risk-on stuff there, are driving the performance currently in the market. And if you look at the tech call options volume, this is pretty incredible stuff, right? We're seeing massive moves to the upside. This is one of the highest that we've seen in 2025. You can see over here, was earlier 2025, where we saw a bigger spike as well, which means the crowd is seeing right tail as the main risk in MAG. So this means that the downside hedge setups are offering up some pretty good pricing. And this is a chart from the market here. And you can see MAG 7 1-month put call skew equally weighted. And it's at this significantly low point that we haven't really seen since January of 2021. The market's up 16% year to date. And this is coming off prior 20% plus years. And I highlighted this in another video showing the times that we've seen two back-to-back 20% years. And you got to go back to leading into the dot-com bubble is when we saw that. That was 1995, 96. Then we had another one in 97 and in 98. So we had 4 years in a row of 20% gains. And this one ended up being like, 16%. I don't remember, but it wasn't 20. It was like right there though. Okay. So as far as magnitude of dot-com bubble, I mean, we haven't seen no 4 years in a row of 20% gains, but I mean, we're working on a third year in a row if it keeps pressing up higher. Now, prior to that, you could see 50s, right? It was a long time ago. It's rare. It's very rare to happen, which is why we're seeing all this bubble talk, right? Because it's rare. And the last time we saw it, right, was over here, like 97 and 98. Right, that was, 97 and 98. Those were the years. Then 54, 55. Before that, 35 and 36. Okay, this is a long time ago. Way different markets, way different environment. Then before that was right coming into the 1929 depression. All right, and now we're getting a book by Andrew Sorkos, or I forget what it is, but it's a book about 1929 crash. Holy moly, man. It's the bears are getting loud out there, but they ain't doing anything, Here's an interesting chart also by the market here. It's actually, I found it on the market here, but it's by, I think it's the sources from Goldman Sachs, to be clear here. It's saying weird market. The S&P stayed above its 50-day moving average for 128 days, one of the longest streaks ever. But at the same time, more stocks are hitting 52-week lows than highs, which is, we're seeing that the new high, new lows. We're seeing a lot of new lows, and that's kind of that divergence of market, right? So the market's been pushing. However, we're getting a lot of weaker stocks in between. Sorry, meant to pull up this chart. The percent of stocks above the 50-day moving average. Market price is higher. This has been going lower. I thought this was interesting too, and I shared it just last week. The housing market and S&P 500 weekly correlation broke down quite negatively. I'm highlighting the other times that we've seen this. It's pretty rare to see this take place. We saw it happen leading into the financial crisis. We've seen it happen over here. You can see, right? That's the financial crisis over here, and over here. And you can see on shorter time frames, right? If you're just looking at the housing market and the S&P 500 down here, this keeps going lower. And which means that this could either play a catch-up run and start moving. Awesome. Could be some good opportunity, or you're going to see the S&P 500 eventually catch down. And you could see that when you have these matching highs or lower highs in the housing market, but the S&P 500 goes higher, it leads to sell-off, right? It leads to sell-offs. Over here, we saw a sell-off, and we saw this as an indication. And then it also could be very bullish to see a higher low, like we saw over here going into 2023, where the S&P 500 went lower, but then housing market went higher, and then the market went up. I did see an interesting break in LQD and also HYG today, the smart money. So the smart money had a pretty significant break today, and the S&P 500 held its own, and that's probably due to Amazon and NVIDIA today. So this is going to be an interesting to watch. This is a pretty fast snap down, and there is no divergence here necessarily, right? I mean, I guess, it's HYG is making another low here while this isn't, but I like to see lower highs, right? And then higher highs for negative divergences. And on the flip side, I like to see, right, higher lows versus lower lows over here. So it is interesting to just point that out. Another interesting chart that I put together today is looking at the dollar of what the dollars move in 2017 or leading into 2017 versus the dollar today. And I've been pointing this one out. Basically, actually, this is what led me to believe that China could be a good play going into 2025, why various risk on asset, why gold, right, could be a good play. I haven't shared that interview, but I have shared that interview, but in the Discord, that was the one that I did at the NASDAQ. But you can see here, leading into the Trump's first term, we saw a massive rally in the dollar, right? The market started driving the dollar higher going into the 2017 Trump's first term when he was in office. bam, the dollar went a lot lower. You can see that in blue, okay? And what I've been calling out is just very similar like pivot points in the dollar and then falling points, right? And then little bounces here and there. And then more recently, we talked about how here in the month of September, you find a low in the dollar. And well, the dollar found its low in 2017, right in September, shortly right there. That was the low print of the year in September for this year's dollar. And then we rally and look at, you can just see it's going, it's like picture perfect. But the reason why I'm pointing it up now, because now we're moving into the period of where you start to see the dollar roll back down and so forth. So is this potentially going to add fuel to the markets and potentially get some sort of a year-end rally, get people pumped up, excited, Santa Claus comes and visits, and then maybe 2026, we start to see things shake up a little bit? I would like that. I would like the market to continue on. You know, despite everyone thinking that I'm super bearish, I pretty much only trade from the long side. If we take a look at the dollar itself from absolute trade-weighted dollar perspective over here, you can see we had a bullish divergence. Boom, it broke out. We've been watching this. Maybe perhaps we get up to the 100, 100.5, and maybe we find right where we were, where we saw prior resistance. Maybe that resistance holds. Another thing to watch is the 10-year yield. It has been bouncing here, but it's a series of lower highs. So one might think that, hey, is these treasury yields going to start to reverse here soon and head lower, given one of the narratives that we recently talked about just today about the Fed, right? So I'm not going to hash those narratives in about that, but perhaps that might be a driving force. There's all kinds of potential catalysts right around the corner, including in a couple of days where we talked about on the prior video with the lawsuits for the tariffs, right? And whether, you know, what comes out of that. We'll talk about that another day, or just watch the prior video. But is this going to start backing off here? And I think that might be a possibility for rates. I mean, it's funny that we cut rates, right? The Fed cut rates 25 basis points and this flies right back up. So is this just an initial reaction, going to be a lower high? If so, this is an opportunity here, I believe, in something like TLT, or you can look at like other bond proxies, right? Like you can look at all kinds of things. Like you can look at municipal bonds, right? There's all different types of things. I'm just using TLT as the proxy, but you see a higher low, higher low, higher low, higher high, higher high, higher high, higher high, and now you get into pullback, right? So is this a pullback, meaning that we're going all the way back down here? I don't know, maybe, but as it stands, the structure is telling us that the short-term trend from being neutral to bearish has now shifted in a more positive light. 50 days inclining, the 200 days starting to turn up here too. Perhaps this is an opportunity to play right back up into 92 and potentially even head higher. If we look at 10-year yield relative to oil, the oil is the black line. You can see oil actually found its low, which is why we started saying that oil started moving. Perhaps that means that we're going to see a move higher in the 10-year yield. And we did. Okay. So now if oil starts to just consolidate or maybe pull back down here too, perhaps that means that gives us more indication that the 10-year yield will reverse. Let's hop over to Bitcoin. The Sailor to Shift tool did get a sell signal over here leading into October. The official trigger was a little bit later. And from that point, we are starting to turn back up, but yet we have no buy signal, buy trigger, and we're still seeing relative weakness in Bitcoin right now. And this Sailor to Shift tool, if you have no idea what this is, it's legitimately the best indicator out there. I put this thing together. It's predicted it's caught every big crash in Bitcoin and every big run up. It's not perfect by any means. There's still whipsaws. So watch the video if you want to learn more about it. But it has been a great tool to help get you on the right side of trade when it mattered the most. And I say mattered because you never know, things can change, but so far, so good. If you take a look at the absolute price of Bitcoin, it's just under that 110, breaking to the lower parts of this channel. Not the greatest look. The 200-day is still inclining. Relative weakness versus the S&P 500 still remains. That crossed down over here in earlier October. And yeah, so it's kind of going sideways. We brought up Ethereum on the other episode as well, saying that it looked rather weak over here and it did start breaking. So the bulls need to step in like right now if they want to protect this thing from falling, because it does look kind of more like a rounding top. And it looks like if it does go for it, we're going down to 2,800, 3,000 range, you know, where we saw this other volume kind of traded. We'll see if that's the case. I do find it interesting looking at semiconductors. Now, if you go through semiconductors and if you look every year, go dip it 5, 10 years, just go do it. Just tell me how many times semiconductors had a 20% drawdown every year, right? Did it have a 20% drawdown? And the answer is yeah, every year it pretty much had a 20% drawdown. I don't have it in front of me. I can't remember if I was looking at NVIDIA for semiconductor. I think it was SMH when I was looking at it, but 2025, right? We had a 20% plus pullback right over here, right? 2024, we had over 20% pullback, all right? And we're going to see that again. Right, that's going to happen. It's going to happen. I don't know when, I can't time it, but after a big run up like this, we're probably closer to a pullback of a 20% drawdown than we are anything, right? Because of the velocity of this run. You do see a bearish divergence forming in the RSI, just like we saw over here. But once again, this does not mean go hardcore shorting it, because we get some more NVIDIA news or AI news or whatever the case is, and you can see some of these semiconductors absolutely take off more to the upside, and this thing just keeps going, right? So if you do anything, do it with just risk focused at your main, just focus on risk, the main thing, not how much you can make, okay? Because if you start thinking about how much you can make, it's going to deter you away from the only thing that you can control, and that is your risk. All right. Let's take a look at market conditions. So if we look at the direction of the 5-day moving average on SPY, is starting to flatten out and we're below it, giving us a little bit of a red warning sign over here. It was cautionary, now it's red. So price action has to get it back above that. Q's not quite yet. Semiconductors not quite there. XBI did break down today. AWM is declining right now, and same with the Dow Jones Industrial Average. Traders are still reaching out to 7,000. That's that call wall. I would say that would be the year-end target. I don't see us getting much further past that for this year. I think that that's going to be the one to go for and the one to get hung up at. And I'm not just saying that just because it's the current call wall, but that was also, that was the current spot here on the JPM caller over here too as well. Now, we are at a pretty interesting area. We're basically right under this 68.50 level, and there's not much going on beneath us. So be aware of that, right? We're basically at 68.50 right now. And if we start breaking down, I would just be paying attention to that gamma flip line, which is roughly at about 67.60, and the lower weekly. Now, the gamma flip line is how I really determine market conditions. When you get under the gamma flip line, there's a high likelihood volatility is going to increase, because dealers are now selling into selling and buying into buying. I don't have that chart in front of me to share with you right now, but it is pretty incredible looking at the times that we cross under the gamma flip line and tracking it and looking at the VIX. And it's pretty impactful stuff. So if you want to protect yourself, be very aware when you're under that gamma flip line, and be aware of what the market's pricing for risk. For SPX, 69.50 to the upside, 67.33 to the downside. Here are the daily implied moves for the SPX. We'll get into SPY here momentarily. If I look at back month versus front month volatility, it did recently tag into and above 20%, which means that back month was 20% higher than front month. That's typically where you get pullbacks and consolidations. I would say that right there is a consolidation. We're not really too far off of getting back above 0.20, which would mean what? Means that we're probably still due for some consolidations and a pullback if that were the case. If we take a look at expected moves, this is SPY. I'm looking at the weekly time frame. SPY on the daily time frame, looking at weekly implied moves in orange, and you can see here, look how good it's been doing with kind of handicapping risk. We, bam, tagged the lower implied move here. Bam, we close at the upper implied move here. This week we broke down, and that we kind of prepared for. That was a big down day, and things were set up for that because of vol control funds, CTAs, etc., but mainly vol control funds. Then we tagged the upper one, bam, we tagged the upper one, bam, we tagged the upper one last week, and now we have $10.87 of expected risk for this week, and we're slightly up on the trading session. So if we come down and tag the lower weekly implied move, what does that mean? It means that just still well within one standard deviation of risk. I feel like people could get quite bearish seeing that and, scared, but really in all reality, if you look to the left of the screen, that would just be back testing this big breakout kind of breakdown bar, and it would be filling the gaps of this recent gap up. So pay attention down here at the lower implied move. If we want to keep continuing going higher, we'll look at $10.87 higher. I'll give you those exact levels right now. 692.93, and that would also be in confluence with, oh no, you know what? Ignore that monthly implied move. I didn't update that one. The upper monthly implied move is up here at 708.18. I just didn't update it on this particular chart. Now going into tomorrow's trading session, there's a couple levels I want you to pay attention to. All-time high anchored VWAP and the 5-day moving average. We're below it right now, okay? Which means what? Means let the market prove itself before you try to prove to the market that you're correct, right? If you're below this and it's been rejected pretty hard, look at this hit. Bam, you got here. Bam, we rejected. Over here again, pretty big push hard. Pulled into it again. Bam, rejected. Oh, we gapped above it today. Boom, rejected right down through. We came back into it, pushed back, okay? Which tells me that the all-time high VWAP bears are defending it, which means that if the bulls can overtake it, that would be quite nice. That would send us up higher, in my opinion. Okay, so as this is turning red, right, we're starting to flatten out, turn down, we're below this. I'd be paying attention to the lower lower daily to lower weekly implied move until we can prove ourselves and the bulls step up and prove themselves to break above that. Till then, we're really kind of just in that choppy range, right? If we come down to the lower portion of this range, we'd be right there at the lower daily implied move where we saw these prior lows. And then we would just be in a range, right? We'll see what happens if it breaks down or if it comes back up and we can finally get through that. Okay, I want to go ahead now and look at some of the monthly implied move. Here's SPX. So this is for the month of November. This is what the market is pricing in for the month. And if you want these levels, right, they're all in the Discord. I'll give them to you now, but you can look them up for any chart that's optionable with my AstroBot, which is awesome because now I have the Astro alerts. It's freaking cool as heck. I'm going to have to do a separate video on that because I've been trading them and I've been doing pretty darn good. So I can't wait to share that. Okay, so if I look at this, we have about 6,600 to the downside. That's what market's pricing in for the downside risk. And then to the upside risk, we have about 50 to 70, 100. So it's kind of a zone of risk there. Now for the Qs are looking at about 660 to the upside, down 600 to the downside. And this was September's monthly implied move. This was October's. I'm showing you this because look at, we closed just basically on right outside in September. We had another follow through type month and we closed right on that monthly implied move there again. Okay, so once again, these levels of risk, the markets, these aren't just levels that I'm drawing on my screen. This is what the market is handicapping as far as risk. There's a 68% probability that we stay within it. And many of the times we go and tag those levels. Okay, 68% is one standard deviation. This is one standard deviation of risk. So in November, right, we're looking at about 660 to the upside, 600, sorry, to the downside. So for whatever reason, if we start selling off, people get all frightened and scared, right? Tech takes a little bit of a heater to the downside. Pay attention to what the market's priced in for the month of November. That's all I got for you on today's episode. Hope it helps out, gives you some insight. I'll see you on the next.